The Delta COVID variant, China risks, inflation and Fed tapering are making investors nervous. We expect the pandemic recovery trade to resume as inflation subsides, infection rates decline, the Fed remains dovish and China adds more economic stimulus. The outlook for the cycle favours equities over bonds, the value factor over the growth factor, and non-US over US stocks. Hi, my name is Andrew Pease and I'm the Global Head of Investment Strategy for Russell Investments. Welcome to the fourth quarter update of our 2021 Global Market Outlook. The post-lockdown recovery has moved from energetic youthfulness to awkward adolescence. It's still growing, although at a slower pace, and there are worries about what happens next, particularly about monetary policy and the outlook for inflation. The inflation spike in the United States has been larger than expected, but we think inflation should head back towards 2% in early 2022. This means that even though the Fed could begin tapering back on asset purchases before the end of this year, actual rate hikes seem unlikely before the second half of 2023. Overall, we still like the outlook for the cycle over the next 1 to 2 years. The major economies are still in the recovery phase of the cycle, which means they have plenty of spare capacity. This should allow them to record above-trend growth without generating longer-term inflation problems. Another worry is the highly contagious COVID-19 Delta variant. The evidence so far is that vaccines are preventing serious infections from Delta. The good news is that vaccination rates are rising globally, and vaccination rates in emerging economies are catching up with developed markets. Infection rates look like they peaked globally in early September. This means the reopening of economies should continue over the remainder of 2021. The onset of winter in the Northern Hemisphere will be a test, but the rollout of booster vaccination shots should help prevent wide-scale renewed lockdowns. The other thing investors are worried about is the outlook for China. China was the first economy out of COVID and the first to unwind policy stimulus. China's economy has been slowing this year due to a combination of policy tightening and some localized outbreaks of COVID, although these have been brought under control. There have also been worries about defaults by property development companies. Senior officials have signalled that stimulus is on the way, and we expect that any financial stress in the property sector will be managed. We think that China's economy should improve through 2022. China policy direction and credit trends, however, will be an important watch point over coming months. The conclusions from our cycle, value and sentiment investment decision-making process are mostly unchanged from our previous quarterly report. Global equities are expensive, with the very expensive US market offsetting better value elsewhere. Investor sentiment was overbought earlier in the year and is now back to neutral levels. We think the medium-term outlook for the cycle is positive, and this delivers a preference for equities over bonds for at least the next 12 months, despite expensive valuations. It also reinforces our preference for the value equity factor over the growth factor and for non-US equities to outperform the US market. Let's turn to our asset class preferences. We prefer equity markets outside of the United States. The economic recovery from the pandemic is more advanced in the United States compared to other developed economies. This means there is more potential for catch-up in the rest of the world, and this should allow economic growth and market leadership to rotate away from the United States. This rotation should favour undervalued cyclical value stocks over expensive technology and growth stocks. The rest of the world is overweight cyclical value stocks compared to the United States. Emerging market equities have been relatively poor performers this year, but there are some encouraging signs. Emerging markets are catching up with their vaccine rollout, and policy easing in China should soon improve the economic growth outlook. China's regulatory crackdown has caused significant underperformance by Chinese tech companies, but this should be less of a headwind going forward now that it is priced in. High yield and investment-grade credit are expensive on a spread basis, but have support from a positive cycle view that supports corporate profits growth and keeps default rates low. We see some better value in emerging markets debt, and this will get some support from US dollar weakness. Government bonds are expensive, and yields should come under upward pressure from above-trend economic growth, and as central banks start to taper back asset purchases. We think the US 10-year Treasury yield could rise towards 1.75% in coming months. The US dollar has been supported this year by expectations for early Fed tightening and by US economic growth leadership. It should weaken as global growth leadership rotates away from the United States and towards Europe and other developed economies. The dollar typically gains during global downturns and declines in the recovery phase. The main beneficiary is likely to be the euro, which is still undervalued. We also believe British sterling and the economically sensitive commodity currencies, the Australian dollar, New Zealand dollar and Canadian dollar, can make further gains, although these currencies are not undervalued from a longer-term perspective. Vaccines are proving effective against the Delta COVID-19 variant. This means that the pandemic recovery trade should soon resume. This outlook favours the continued outperformance of equities over bonds. It also means that the rotation away from expensive technology growth stocks and towards cheaper cyclical value stocks should soon resume. Thanks for watching, stay safe, and we'll talk again soon.
Hi, I'm Eric Risteman, Chief Investment Strategist for Russell Investments. If you like what you saw in this video and want to see more like it, please subscribe to our YouTube channel.